Most families have no idea. Inheriting a health savings account as a non-spouse beneficiary creates an immediate and devastating tax consequence. The entire balance, potentially $50,000, $75,000 or more, becomes taxable income in a single tax year. For a household in the 24% federal bracket, that's $12,000 to $18,000 tax bill arriving on top of whatever else you earn that year. And the research shows this isn't rare. It's a structural gap in tax planning that catches thousands of families off guard every year. But there's a spousal exception buried in IRC Section 223 that most families don't know about, and understanding it could save your family tens of thousands of dollars. ***, the HSA inheritance tax trap. How IT works ***. Let's start with the basics. A health savings account is one of the most tax-advantaged savings vehicles available to American families. You can contribute pre-tax dollars, earn tax-free investment growth, and withdraw funds tax-free for qualified medical expenses. For decades, financial planners have recommended HSAs not just for immediate healthcare costs, but as stealth retirement accounts, a way to build a tax-free medical fund over time. But here's the catch that most people miss. HSAs have special rules when the account owner passes away. When you die, your HSA doesn't disappear. It passes to whoever you named as the beneficiary. But unlike a traditional IRA or 401k, where a spouse can roll the account into their own retirement plan and defer taxation, an HSA has completely different rules depending on who inherits it. If your spouse inherits your HSA, they can treat it as their own HSA, continuing the tax-free growth and withdrawals for qualified medical expenses. Simple, elegant, tax-efficient. But if anyone else inherits it, your adult children, your parents, a trusted friend, or even a trust, the IRS considers the HSA distributed in the year of death. The entire balance becomes ordinary income to that beneficiary, not capital gains, which get preferential tax rates. Ordinary income, taxed at whatever marginal bracket the beneficiary falls into. For a concrete example, Sarah, age 68, has diligently saved in her HSA for 15 years. She's never touched it because her Medicare-eligible employer plan covered her medical costs. Her HSA has grown to $87,000, mostly investment gains, all tax-free. When Sarah passes away, she names her daughter, Jennifer, as the beneficiary. Jennifer is a teacher earning $55,000 per year. When she inherits the HSA, the IRS considers the entire $87,000 taxable income to Jennifer in that year. Jennifer's total taxable income that year becomes $142,000. Depending on her filing status and state taxes, she could face a federal tax bill of $20,000 to $25,000 on top of regular income taxes. Now, if Jennifer's mother had instead named her spouse as the primary beneficiary, with Jennifer as secondary, the story changes completely. The spouse inherits the HSA, rolls it into their own HSA, and Jennifer gets nothing in the short term. But the HSA is preserved for the family, and when the spouse eventually passes, the value might pass to Jennifer without the same immediate tax consequence, or the spouse could withdraw funds for medical expenses tax-free, reducing the balance before Jennifer eventually inherits. The scope of the problem ***, you might think this is a niche issue affecting a small percentage of families. You'd be wrong. According to the Employee Benefit Research Institute, EBRI, as of 2023, over 30 million Americans have HSA accounts. The average HSA balance for families approaches $5,000 to $8,000, but for long-term savers, especially those who have contributed for 10+ years without withdrawals, balances regularly exceed $25,000, $50,000, or even $100,000+. Fidelity's 2023 retirement healthcare cost estimate suggested that a 65-year-old couple retiring that year would need approximately $315,000 in today's dollars to cover healthcare expenses in retirement. For many planners, the HSA is supposed to be part of that solution. But here's the uncomfortable truth. Most people have never discussed their HSA beneficiary designation with a financial planner or tax professional. Many inherited their HSA selection when they opened a plan through their employer and never revisited it. If the default beneficiary is often my estate or a deceased relative, or if it's a child from a first marriage while you're now remarried, the tax disaster is built in. Take the case of Robert and Martha, a blended family. Robert had 2 adult children from his first marriage and was remarried to Martha. His HSA, which had accumulated to $62,000 over 12 years, still listed his eldest son as the beneficiary from when Robert set it up in 2010. When Robert passed away in 2024, his son inherited the $62,000 HSA, faced a sudden $12,000 plus federal tax bill at 24% marginal rate, and was surprised to learn he had no recourse. Had Robert's beneficiary been Martha, the family would have retained full control and tax efficiency of the assets. **, the spousal exception, IRC Section 223, and the game changer **, this is where it gets interesting. The Internal Revenue Code Section 223, which governs HSAs, includes a special provision that most estate planners and even some tax professionals overlook. If your spouse inherits your HSA, they have the election to treat it as their own HSA. When they do, they can 1. **, continue the tax-free growth **, of the remaining balance. 2. **, make their own HSA contributions **, if they're still in a high-deductible health plan. 3. **, withdraw funds tax-free ** for any qualified medical expenses, including expenses they had, the deceased spouse had, or even beneficiary dependents have. 4. ** invest the balance ** without any required distribution timeline. This is fundamentally different from the non-spouse beneficiary rule. For non-spouse beneficiary, here's what the law actually says. The HSA is considered distributed in the year of death. The value becomes ordinary income, period. The beneficiary must report it on their tax return. There's no election, no exception, no, but what if I don't touch the money? Loophole. But for a spouse, the election changes everything. The spouse steps into the deceased spouse's shoes and continues the HSA as if they owned it all along. **, practical walkthrough, how the spousal option works **, let's follow a detailed example to understand the mechanics. David and Lisa are both 62 years old. David has accumulated $78,000 in his HSA through careful contributions and disciplined withdrawals. He only takes out when necessary. Lisa is still working and contributes to her own HSA, which has $22,000. David passes away unexpectedly. His will and beneficiary designations list Lisa as primary beneficiary. When Lisa inherits David's HSA, **, Step 1, the notification. **, the HSA custodian, often a bank or investment firm, notifies Lisa that she is now the beneficiary of David's $78,000 HSA. **, Step 2, the election. **, Lisa has a critical choice, though many beneficiaries don't realize it. She can either treat the inherited HSA as her own, the spousal election, treat it as a separate inherited HSA, the non-spouse election. **, Step 3, the spousal election route. **, if Lisa chooses the spousal election, she notifies the HSA custodian that she's treating this as her own HSA. The $78,000 becomes part of Lisa's HSA balance. She doesn't report it as income. She doesn't pay taxes on it. Instead, her HSA balance becomes $100,000, $22,000 original plus $78,000 inherited. Lisa can then continue working and contributing to the HSA. If she's in a high-deductible plan, invest the balance in stocks, bonds, mutual funds. Whatever the custodian allows, withdraw funds tax-free for qualified medical expenses in retirement. Use these funds for Medicare premiums, long-term care insurance, and other qualified expenses if she passes away. A spouse could do the same. If a non-spouse inherits, they'd face the tax on that date. **, Step 4, tax consequences. **, Lisa files her tax return for the year of David's death. She doesn't report the $78,000 as income because of the spousal election. She continues normal HSA reporting from that point forward. Compare this to what would happen if their adult daughter, Jennifer, had inherited David's HSA instead. Alternative scenario, non-spouse beneficiary. Jennifer is notified she inherited David's $78,000 HSA. There is no spousal election available. The IRS treats the full $78,000 as ordinary income to Jennifer in the year of inheritance. Jennifer reports this on her tax return. At her 22% marginal tax rate, federal plus state and FICA implications, she faces approximately $17,000, $19,000 in immediate taxes. She must pay this by April 15 of the following year. Jennifer has no option to defer this. She can't elect to treat the HSA as her own. She could preserve the remaining balance, $78,000 minus her custodian fees, in a separate inherited HSA account, and going forward, she can withdraw funds tax-free for her own qualified medical expenses. But that one-time income tax hit is unavoidable. Common mistakes and misconceptions, mistake #1, my spouse knows they should be the beneficiary. Fact, many people have never explicitly named their spouse as HSA beneficiary. Default beneficiaries, outdated designations, or assumptions about who should inherit create disasters. Action, review your beneficiary designation today. Call your HSA custodian and confirm who is listed. Mistake #2, I don't have much in my HSA, so it doesn't matter. Fact, HSAs are designed for long-term accumulation. A $5,000 balance today could grow to $30,000 plus in 15 years. If you're young and healthy, you might not realize your HSA's long-term value. Mistake #3, my estate plan is up to date. I'm covered. Fact, many comprehensive estate plans focus on wills, trusts, and major assets, but never revisit beneficiary-designated accounts. Will doesn't control HSA beneficiaries, the beneficiary designation form does. Mistake #4, only the spouse can avoid the tax hit. Fact, true, non-spouse beneficiaries cannot elect spousal treatment. The tax is triggered no matter what. Counterargument, what if I want my kids to inherit the HSA? Some families intentionally want their adult children to benefit from accumulated HSA funds. Fair question. Here are legitimate strategies. Strategy 1, spousal primary, child as contingent. Name your spouse as primary beneficiary. At your spouse's passing, name your child as the successor beneficiary. The tax is deferred until your spouse's death. Strategy 2, spend it down in retirement. Rather than hoarding the HSA, use it strategically for retirement medical expenses. Pay for long-term care insurance, out-of-pocket medical expenses, dental, vision. Reduce the balance to a reasonable level, say $15,000, $20,000, to cover final medical costs. This limits the tax burden your heirs face. Strategy 3, understand the trade-off. If you genuinely want your child to inherit the HSA and don't mind them facing the tax bill, that's a choice you can make. Just do it intentionally and make sure your child understands they'll have a tax liability. Strategy 4, establish a qualified Medicaid trust. In some cases, HSA can be inherited by a trust beneficiary with slightly different rules. Consult a tax attorney on whether this applies to your situation. Action steps. What you should do now. 1. Find your HSA documents. Locate your most recent HSA statement and beneficiary designation form. If you can't find it, call your custodian. 2. Review the beneficiary. Is it your spouse, if married? Is it current? If it lists an ex-spouse, a deceased parent, or your estate, it needs updating. 3. Update if necessary. Contact your HSA custodian and request a new beneficiary designation form. Name your spouse as primary if married. You can name secondary beneficiaries if you wish. 4. Communicate with your spouse. Make sure they know about your HSA and the spousal election option. If you're married,